Hello, and welcome to the Georgetown Passero Center for Financial Markets and Policy's virtual FMQ webinar on Professor David McLean's book, The Case for Shareholder Capitalism. I'm David Vandeveer, Executive Director here at the Passero Center for Financial Markets and Policy. We are the preeminent destination for unbiased expertise at the intersection of finance and policy. The Passero Center provides thought leadership and actively contributes to shaping global finance. Located in Washington, D.C., we connect policymakers, industry leaders, and scholars through solutions-driven platforms. Financial markets are undergoing transformational changes with a heavy focus on AI, crypto, digital assets, growth of private markets, and more. Today's event is focused on Professor David McLean's book, which discusses the role of shareholder capitalism in the current business and economic climate. We're absolutely delighted to welcome David McLean and Mike Piwowar for this virtual FMQ webinar. David is the William G. Drom's Professor of Finance and Finance Area Chair at Georgetown University's McDonough School of Business. Mike Piwowar, our moderator, is the Executive Vice President at the Milken Institute Finance. Mike was the Commissioner and Acting Chair of the Securities and Exchange Commission. He also serves on the advisory board here at the Passero Center. This is going to be a great conversation, so let's get started. Over to you, Mike.
Thank you, David, and thanks for that kind introduction. And also thank you for everything that you do for the Passero Center, particularly what you do with the students. It is a fantastic opportunity for them at Georgetown. It's my absolute pleasure to interview Professor David McLean about his book, Shareholder Capitalism: How the Pursuit of Profit Benefits All. It is one of the best books I've read in the past few years, and I consider myself to be particularly well informed on the topic given my background. And I still learned quite a bit from reading it. During today's conversation, we're going to hit on many of the key themes of the book, but to really understand everything there is to know about shareholder capitalism, you need to read this book. Now, before we start with the conversation, for those of you that are watching this live, you will have the opportunity to submit questions to the Zoom chat. And we'll take a look at those. And as we go along, if there's any questions that we think are particularly good or relevant, we will ask your questions to David. So, David, let's get started. What exactly is shareholder capitalism, and why did you decide to write this book?
Okay, well, great. Thanks, Mike, and thanks to the Center for having me here to talk about the book. So the overarching idea in shareholder capitalism is that the purpose of a business is just to create wealth for its owners. Of course, in a corporation, we refer to the owners as shareholders. I think, but that idea that the goal of a business is just to create wealth for its owners, it could really apply to any business. It could apply to a partnership, a sole proprietorship, private corporation, public corporation. It's not anything about corporate law or anything about that. It's more of an economic thing about the role of business in society. So why did I write the book? So if you take a finance class, even just an intro to finance class, the professor usually starts the class like this. They say, well, the goal of the firm is just what I said. It's to create wealth for the owners. And it'll go on and say, even in a publicly traded corporation where you could have thousands or even millions of shareholders, located all over the world, the one thing they can agree on is they would prefer more wealth to less. Thus, the job of the corporate managers is to create wealth for the shareholders because that's who they work for. And then what we do is we go on and we develop various analytical tools to decide if we're actually doing that. Like if a firm makes an investment, does it create value for the shareholders or not? What we don't do really at all, in my experience, is talk much about what does that mean for everyone else in society. So if the goal is to maximize shareholder value, how does that leave like your customers, your suppliers, your employees? What does that have to do with economic growth? I mean, just broader societal questions, we just kind of stay silent on them and just get into our kind of finance analytical tools. And I think because we do that, it created a void, and the void was filled. So we need answers to those questions. What is this? How does this leave the rest of society? There's a void, and the void was filled by answers that, at least in my opinion, are inaccurate. Answers that misrepresent shareholder capitalism. What a firm, the actions of a firm that are trying to adhere to shareholder capitalism, what it would actually do, how it would leave everyone. And at the same time, various kind of like substitutes, or maybe you could say add-ons to shareholder capitalism, became increasingly popular, like stakeholder capitalism, ESG, corporate social responsibility. And I think a lot of those things are mischaracterized and don't come as advertised either. And so I wrote the book to address all of that. And I'll say the book, it's completely non-technical. I wrote it for everyone. I wanted to write it for even someone who never took a finance or business class, because I think the issues are just important for everyone to understand. And so it's written in that way. And I'll talk about it in that way here in our talk today too.
No, that's exactly right. I mean, that's what
Yeah.
makes it so readable. Like even someone, like me who has a background in economics and finance, like I said, I still learn some many things. And for folks who have not had any classes in economics, I mean, this is actually a great book to read that then you can go into your Econ 101 class and actually understand, a number of the core concepts that you're going to be learning in that class. And on that note, you don't start actually with shareholder capitalism.
No,
You
yeah.
start the book, you go back and you look at the historical importance of trade and specialization, which again is what you would learn in an Econ 101 course. So how you spend a lot of time on that. How does a concept of mutually beneficial trading define that, and how has it evolved from ancient times to modern shareholder capitalism?
Yeah, great. So first of all, just maybe like some definition. So I would say like, what does the word capitalism mean?
Yeah.
And so I would, capitalism, I think, just describes an economy where people can choose to freely trade with each other or not. So people can choose to trade, they can choose not to trade, and there's no government or third party kind of interfering with that. So I don't think any society is perfectly capitalist. It's always to some degree, but that's what kind of capitalism describes. And so when I wrote the book, I said, okay, maybe it's kind of cool to think about how old is capitalism? Like, where did it come from? And actually, the word capitalism is a little bit misleading. As I learned a little bit more about it, it's actually originally a pejorative. It was created by socialists in the 19th century who wanted to kind of replace the system. They didn't like it. So capitalism, again, it's not an ism. It's not a philosophy or a system of beliefs. It just simply describes an economy where people can choose to trade with each other or not. And so then I got interested in how long has that been going on. And actually, you really can't learn that from historians. You have to learn it from archaeologists. And so what I learned is like the oldest evidence that we have of groups of humans engaged in trading with each other. It's actually a recent series of studies from the Smithsonian Institute puts it back 310,000 years. So Homo sapiens are maybe 300,000 years old. The oldest evidence of what at least archaeologists say are long distance trade routes in East Africa go back 300,000 years. Some of the evidence is that, so you have this volcanic stone called black obsidian, and you can chisel it into really sharp objects. And what they would find is that they would find evidence of like obsidian tools in one site, but the nearest obsidian is like over 100 kilometers away, and they believe hunter-gatherers didn't go over so far distances. And so that and some other evidence they pieced together that maybe there are long distant trade routes. So the oldest is 300,000 years, but there's many studies coming to the same conclusion with archaeological sites of 200,000 years old, 50, 60,000 years old. So this idea of like people trading with each other, it's like very ancient in our DNA. There's one study that asked, when humans first left Africa and went to Europe, the Neanderthals were living there, and the Neanderthals were physically superior to us. They're stronger. They could deal with cold weather better. So how come the humans survived and then the Neanderthals didn't? And again, archaeologists that have studied early humans living in Europe believe that we traded with each other and they didn't. And the reason trade could maybe help ensure your survival is that when two people trade with each other, well, they don't trade unless each side benefits. So if two groups of hunter-gatherers trade and, say we're trading fur for spears, I mean, each side comes away better off or they wouldn't agree to the trade. So if you take that forward to modern times, so think of like, any of us, our economic life. So what do? We trade with probably a business. I mean, I trade with a nonprofit with Georgetown, but we trade our labor for our wages. And then we take our wages and we trade for everything else in our life, all our goods and services. We trade for our food, for our shelter, for our clothing, iPhones, vacations, everything else. And so when we engage in this trading, we're really, we're doing kind of the same thing that we did hundreds or thousands of years ago. It's just, more sophisticated and the products we make are much more specialized. But I think like the essence of that hasn't really changed much. And to see how important trading is, just imagine as a punishment, like someone, a judge were to say, okay, you're not allowed to trade with anyone. How long would you survive, right? You'd have to come up with your own shelter, your own food. I don't know about you, I wouldn't survive very long. So trading, it's this ancient thing. It's in our DNA, and it works because it's something that both sides, when you talked about mutual benefit, can come away better off. And some people kind of miss that sometimes. But anytime you trade, you agree to it because it works for you. Like a simple example, if I go to Starbucks and buy a cup of coffee, well, I came away better off. The coffee is more valuable than the price I paid for it. But then Starbucks came away better off. They made a profit from it. So, with trading, it's a positive sum game. It's not a zero sum game. And it's a game we've been playing, I think for all of humanity. For as
No,
long
and
as
the and,
it's been
and the
there.
key
Yeah.
link you're pointing out there is that, corporations are sort of a nexus of all of these trading markets that we have here, right? So you mentioned
Yes.
employees, that's the labor supply market. You mentioned the products, that's the product market. They're offering their shares, that's the securities market. The suppliers, there's a market for suppliers and buyers of all that stuff. So we'll get into those details. But
Sure.
I mean, that was a great way to sort of motivate what was going on here. Now, so you mentioned capitalism was a pejorative term, brought up by the socialists or the communists, right? And it's, sort of reducing, the means of production to capital and not the human part in there, right? And so there's,
Right.
I tend to use the word free enterprise, but other folks like capitalism, even words, even phrases like human capital, right? Folks say, oh, what kind of human talent stuff? But let's talk about communism here. In the book, you do a great
Sure.
example. You say, look, the opposite of capitalism is communism. And so, what are some of the lessons from the historical experience from that we want to try to avoid?
Okay. Yeah. So, first of all, I think like the origins of communism and capitalism are very different. So I would say the origin of capitalism, it's Africa, and it's just basic human behavior, and just humans doing what humans naturally do. So in communism, instead of people deciding whether they get to trade or not, kind of like the means of production are controlled by the state. So in capitalism, modern capitalism today, we have profit-seeking firms. I mean, I wrote the book because I'm very much in favor of having profit-seeking firms. I think they do a lot of good. Communism, again, that was developed by Western intellectuals. It's a I guess an ideology or an economic system thought up by intellectuals. So under communism, the basic idea is that profit-seeking firms are a bad thing. When firms make profits, they actually exploited the workers. It's not like the workers and owners are both coming away better off. It's actually kind of making the workers worse off. Um, and um, and so you needed a different type of economic system. And so maybe in the 20th century, maybe 30, depending how you want to count them, 30 or 40 countries went this way and tried to have a communist economy, where again, instead of having profit-seeking businesses deciding what good services are made, the government decided all of that. And so one lesson from it that we can take away is, depending whose estimates you want to look at, communist governments killed about 100 million of their own people. Some of that came from famines they created, and some of that came from political persecutions. But one thing we learned is that, if you want more like abundance and plentifulness of kind of like resources and other things, communism probably isn't a good way to do that. It just created poverty. And in the extreme, it could create famines. And also, when you give a small group of people that much power, they tend to not do very good things with it. Because if someone's in charge of who gets to eat and where you get to work, that person has absolute power. So maybe yeah, so there's a couple books on it. One, Death by Government, another one, The Black Book of Communism. And I think they both estimate that communist governments killed 100 million of their own people. These are like unnecessary deaths that didn't need to happen. As for the economic performance, you have a lot of kind of like interesting comparisons. So you could compare North Korea to South Korea. So South Korea became a rich free country. North Korea became like it's a poor country and where people have no freedom. You could compare East Germany to West Germany. So when communism ended in Europe, what happened? Did West Germany get absorbed by East Germany, or did East Germany get absorbed by West Germany? So West Germany was relatively rich, East Germany was poor, and I think to this day the West is still richer than the East. The East never fully recovered. And you can look at communist China when Mao ran it, and then when Deng took over and made his reforms. So when Mao controlled China, by some estimates, there's one estimate called Mao's famine that when Mao tried the Great Leap Forward, he has this 5-year plan to industrialize China. It killed maybe 46 million people, some through starvation, some through persecution. And then when China decided to reform itself and liberalize parts of its economy with special economic zone, we see some of the fastest economic growth ever recorded in human history. And those reforms lifted probably more people out of poverty than has ever been recorded in human history. We can compare the performance of just like Eastern Europe and Western Europe. Again, when the Soviet Union ended in 91, Western Europe was rich, Eastern Europe was poor. And then what's also kind of interesting is that in 87, I have a book called The Turning Point. It was actually written by Soviet economists. So this is when Gorbachev had kind of gotten control of the Soviet Union, and was writing. And these economists basically just explained how a centrally planned economy can't possibly work. And one of the reasons they came up with, so in a market economy, when you pursue profit, like one way to think about how does a firm make a profit? So a profit represents the value of what you create minus the value of the resources that you used. So a profit means I took things that are of relatively low value to society and I created something that's of relatively high value. If a firm can do that successfully, it makes a profit. So the basic economic problem of any economy is how do we allocate scarce resources that have alternative uses? So in a world with profit-seeking firms, well, if I can use this resource and create something of higher value, then I'll use it. That makes me a profit. But if I can't do that, if I'm going to use these resources and create something of lesser value, that's a loss, and I don't want to do that. So firms avoid doing that. And so in a communist government, because you didn't have profit-seeking firms and because you didn't have market prices, there's no way to figure out what people wanted and needed. So and this is the Soviet economists explaining this. And so you had surpluses in some places and shortages in other places. And so long story short, they said it's kind of an impossible, inefficient system, and we really need to liberalize it. But like as you said, the reason I bring it up in the book, so one is because communism is if profit seeking is bad and capitalism is bad, let's see what happens when you get rid of it. And when you get rid of it, things go really, really bad. So no system's perfect, but that system's a lot worse. But the other thing that's disappointing is like I'm an educator and we don't teach anyone about that. So you would think that, so in the 20th century, the world did this experiment where half the world picked up this economic system and it created, killed 100 million people and created all this type of havoc and really did, it didn't do a whole lot of good, did a lot of harm. But we don't really talk about that. We just kind of swept it under the rug and then talk about, problems that firms are causing and things like that. And rather than talking about all the good things they do and all the bad things that can happen if you were to get rid of profit-seeking firms. So that's why I had that chapter in there.
Yeah, no, I mean it's striking. I mean, you mentioned, profit is revenues sort of minus your cost of creating those revenues, creates a profit. I remember, as an MBA student at Georgetown in the early 90s, we were visited by some accountants, and I use accountants and, I'm putting air quotes here. They were basically bookkeepers under the old Soviet system, from one of the former Soviet republics, and they came to learn about how to become an accountant. And they literally did not even have a word to distinguish between revenues and profits. They said, under the old system, we were told to make 30 tractors a month. And at the end of the month,
Yeah.
how many did you make? 30. And there was no, you know, there's no concept of, did they actually create value in that? Were they actually working? Those sorts of things. So, I mean, it was just striking to me to see that, right? And, as you put in the book, right, communism's great if you want famine and death, but otherwise it's not so good. So,
Yeah.
um, yeah, let's turn. So within having dismissed communism here, within capitalism, there's different sort of views that people have in terms of how a capitalistic or free enterprise system should run. Um, a phrase that's become fairly popular as sort of an alternative to shareholder capitalism is people use the term stakeholder capitalism, and this is particularly relevant in the past few years. So the Business Roundtable, it's an association of like 200 CEOs of the largest companies that you would know of. And for decades, they explicitly endorsed shareholder capitalism. But then in 2019, they updated their statement of the purpose of the corporation, and they switched to what they call a form of stakeholder capitalism and said, 181 of the CEOs, not all of them, but the vast majority, they said we're going to lead the companies for the benefit of all stakeholders. And they define stakeholders as you talked about, customers, employees, suppliers, and shareholders. They also mentioned communities, broader society at large. That's their definition of stakeholder capitalism. But as you kind of point out in the book, stakeholder capitalism is a very nebulous concept. If you ask 10 people their definition of it, you get 10 different answers. So as we continue the conversation and sort of compare and contrast shareholder capitalism with stakeholder capitalism, what do you consider to be stakeholder capitalism?
Um, yeah, like you. So I don't believe there's a firm definition. I don't think people even agree on what's a stakeholder. So I've had people tell me the planet's a stakeholder. And then I would ask them who gets to speak for the planet, but the planet can't talk. And so, how does a corporate manager decide if they're doing things, that's good for the planet or not? But I think it's based on an idea, and I think I argue in the book the idea is false. Is that um, so shareholder capitalism? The goal is to create value for the business of the is to create value for the business owners. Under shareholder capitalism, you're trying to make the business as valuable as possible. It's based on the idea, again, that I disagree with. I'll explain why, that overlooks the other stakeholders.
Yeah.
So because you're trying to create value for the shareholders, you're not going to treat your customers, employees, suppliers, and other people kind of nicely. And that's kind of not good. That's kind of not really fair. And a better system would be a system that kind of puts all the different stakeholders, including the shareholders, on kind of equal footing. So shareholder capitalism, I believe, correctly views like a corporate manager as an employee who works for the shareholders and is kind of running the business on behalf of the shareholders. Stakeholder capitalism views the corporate manager as kind of like a referee. It's maybe deciding things between parties. This is my impression of it. So as an example, like Klaus Schwab on the World Economic Forum website in one of his books has a picture. And in the picture, in the middle of the picture he has the word something called a business. It's like this entity that's a business, and then the business has these different spokes coming out, and it shows that the business has relationships with all these different stakeholders and the shareholders. So there's this entity called a business, and it has relationships with different parties. One of the parties is a shareholder, and the role of like a corporate manager should be to understand how the business interacts with all these different parties in a good way. And so I think the picture is wrong. I think it doesn't accurately describe what's going on. So what I think is going on is that the various stakeholders trade with the shareholders, and that trading, we call that all of that trading a business. So there's not some independent entity that just pops into existence and starts having relationships with different people. What happens is someone starts a business. If that business is incorporated, we call them shareholders. And the shareholders trade with all the other stakeholders of the business, and we call that nexus of trading a business. So like a simple way to see it, like think about like a very small business, like someone who owns a convenience store. And imagine that the owner of the convenience store is also at the cash register. So, if a customer comes in and buys something there, it's very obvious that a trade took place. The customer, bought a candy bar, they gave some money, the owner of the business got some money, they traded with each other. Maybe there's an employee that helps stock the shelves. So again, it's very obvious that the owner pays a wage and the employee does some work, and the owner and the employee are trading. And then the owner of the business also, he buys supplies, and so he's trading with the suppliers. They send him supplies, he gives them money. So this business is really just trading that's going on between the different stakeholders and the owner of the business. And if it's a corporation, we call that owner a shareholder. So now we can add a little wrinkle to it. Let's say the owner decides he doesn't want to run the business every day, so he hires a corporate manager to run it for him. So now what's going on? It's still the customer, supplier, and the other employee. They're still all trading with the owner of the business. The owner just has a corporate manager that's kind of facilitating those trades for him. And if you ask, what's the corporate manager's job? Well, the corporate manager's job is to make the trades in the interest and on behalf of the person that hired him, the owner of the business. And then you might ask the question, well, who looks out for the employee and the suppliers and the customers? And the answer is, well, they look out for themselves because they don't have to trade with this business if they don't want to. And so now, if you think about like a really big company, like a publicly traded corporation, so imagine this convenience store is really successful, it becomes a chain, and you have them all over the place. Well, it's still no different. It's just you can have many different shareholders and lots of different corporate managers, but in the end, it's still just the different entities, the different stakeholders are trading with the shareholders, and that trading is called a business. There's no independent entity that pops into existence that's having these relationships with people. People trade with other people. So, like if I go walk into Safeway this afternoon and buy some groceries, we might say, "Oh, okay, I traded with this corporation called Safeway. I traded with Safeway." But in reality, I didn't do that because this thing Safeway is kind of just a figment of our imagination. The corporation Safeway exists on paper and exists in our imagination, but it's not a real tangible thing. It's a business, and on the other side of the business are the owners of it, the shareholders. And when I go shop at Safeway, I'm actually trading with the shareholders, just like people did thousands of years ago out on the African savannah. It's just our trading here. It's a bit more complicated and sophisticated. And really, I think you can think of a corporation as just a set of rules that organizes like how a business is kind of owned and operated. But in the end, just like people say corporations don't pay taxes, people do. In the end, you don't trade with a corporation. People trade with other people through a set of rules that you might refer to as a corporation. And that's where I think stakeholder capitalism gets it kind of wrong. It doesn't recognize that there's this kind of trading going on. And in a big publicly traded corporation, if the managers aren't looking out for the shareholders, because the shareholders aren't making the decisions themselves, then you don't really have capitalism because it's not really mutually beneficial trading. So the suppliers, the employees, and the customers get to decide if a trade benefits them. You need the corporate manager to decide if the trade also benefits the shareholders. Otherwise, you don't really have capitalism. You don't really have mutually beneficial trading. So large publicly traded businesses under shareholder capitalism, the reason they're looking out for their shareholders is because that's necessary for it to actually be capitalism. For actually, and if it's not, then why would anyone want to be a shareholder? Like, why would I pay money to be a shareholder and have someone run this business for me if they're not looking out for my interest? Why would why would those shares have any value? Um,
Yeah,
so
no, I mean that's a great point.
yeah,
There are those that are, there's actually members of Congress that have put forward some bills that would sort of explicitly force corporations to employ a stakeholder model, and to your point, right? So with shareholder capitalism, right? So there's a question, actually a great question in the chat, which was, doesn't shareholder capitalism ignore the other stakeholders? You just went
yeah.
through and explained why that's not the case. And I'll remind folks, if you're watching this live, there's opportunities to put questions in the chat. And that was a great question that you just happened to already answer. At the end of the day, the managers have to make a decision and sort of whose interest ahead of the others or who breaks that tie, right? It's sort of the interest of the shareholders. And to your point, if you have a stakeholder where everybody's equally, well, who breaks that tie? In many cases, it's going to come up to the government, and then you're into corporatism or statism or at worst communism, those sorts of things. So I don't know if you wanted to comment on that, but
Yeah, well, no, I mean, for trading to be mutually beneficial, both sides have to agree they benefit from it. So I would say, so, a customer, whenever a customer buys something for a firm, the customer only does that because the customer believes it benefits them. When someone chooses to work at a firm, they choose to work at that firm because what that firm offers them in wages and work conditions or whatever is better than what they could get anywhere else, or they'll choose not to work at that firm. When a supplier supplies something to a firm, it's because the supplier makes a profit from doing so. So all shareholder capitalism says is that these groups are all looking out for their own self-interest. So obviously the owner of a business should look out for their own self-interest. That's what trading is. Both sides say, does this benefit me or not? And often two sides decide not to trade, and that's perfectly fine. As far as businesses go, most new businesses fail within 5 years
yeah.
because making profits are really hard to do. You have to have all these other stakeholders that agree to trade with you, and the trades have to make them better off. And then there has to be, I often refer to in class, a profit is just a leftover that a business owner gets to keep after making all the other stakeholders better off because they won't trade with you unless there isn't a profit. And so, yeah, that's not an easy thing to do. And also we only really talk about the stakeholders when there's profits. We don't talk about when there's losses, right? So, yeah, like if you're a venture capital firm, and I think I've seen, data that says like, 3/4 of the things they invest in, they lose money on. They don't make their money back. No one says like, oh, who do those losses belong to? How do we divvy that up? Like who's no, 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 that's the shareholders. But when a firm's successful, then suddenly, oh, let's talk about all the other parties. Well, most firms aren't successful, so you can't just cherry pick the successful ones and say, oh, now that they're successful, let's apply a different model to them. But then that model doesn't get applied to all the ones that were kind of failure. Because when you do that, then no one's going to invest in early stage firms because it's like, oh, if it's successful, if there's a loss that belongs to me, I'm the shareholder. But if there's success that doesn't really belong to me, it belongs to someone else. We have to socialize it. No one's going to play kind of those games. And that's my other, yeah, go ahead. Yeah.
No, go ahead.
Yeah. So that, no, I think I finished.
All right, good. So I was just going to say, right, so you mentioned failures, right? So in the book, you point out, the concept of creative disruption,
Yep.
destruction, actually,
Yeah.
right? Austrian economist Joseph Schumpeter was the one who sort of popularized that term. So what is creative destruction and how is it related to shareholder capitalism?
Yeah. So I guess the term refers to I think it really describes how growth happens in a capitalist economy. So it describes new firms replacing old firms, new products and services replacing existing products and services, new processes to make existing products and services to replace old ones. So Schumpeter's point was that in a growing capitalist economy, this is always happening. Firms are always trying to create things, and when they create something, something else gets destroyed. And since Schumpeter, there's been a couple, I think, Nobel Prizes in economics that kind of reinforce that. So one went to Robert Solow, and Solow's contribution was to show that economic growth, improved living standards over time, only takes place from technological innovation. So once you're a mature economy that has all the most modern technology, and unless you start having new technological innovation, you won't continue to grow. Where technological innovation means like new products and services that people want and need that replace existing ones, or more efficient ways to make existing products and services. So you need that for growth. And then another Nobel Prize related to this came from Paul Romer. So people said, okay, you need technological innovation to grow, but like, where does technological innovation come from? Like, what's the incentive for that? And Romer pointed out that profit's the incentive for that. So Romer points out, say, look, innovation is much different than science. So science is like a general useful thing, but it doesn't necessarily turn into a product or service that people want and need. And Romer pointed out you actually need for-profit businesses to do that. So the reason a business wants to innovate is because when it innovates, it can make higher profits off that. If you make a new product or service that beats out the existing ones, you'll make profits off that. If you can find a more efficient way to make existing goods and services, you can have higher profits from that. And that's why we have patents. We have patents to say, hey, if you make something that's new and good, people can't copy you for a while, so you can keep making profits. So Romer showed that the profit motive, which is similar to shareholder capitalism, the profit motive is what gives us this technological innovation, gives us growth, and that's what drives Schumpeter's creative destruction. They're selfishly and greedily trying to create products and services that people want and need, but that's what raises living standards and gives us economic growth over time. And one thing I'd go back to, we talked about the stakeholders. Like, so who gets to decide which firms survive and which firms get destroyed? It's not the shareholders. Shareholders can propose new things, but the stakeholders have to accept them. I can propose a new product or service, but people have to be willing to buy it at a price that makes me a profit in order for me to be a successful business person. So in the end, the firms that are created and the firms that get destroyed, in a world with shareholder capitalism, the shareholders don't get to decide that. They can propose it, but it's the stakeholders who get to decide if that business is going to be successful or not, because they get to decide whether they trade with it or not. And when a business gets destroyed, the shareholders eat the losses. And when a business is successful, okay, they get to keep the gains. But there's nothing. So there's nothing like when you say you're shareholder capitalism. It's like it's pro business, but it's not pro any particular business. So in a world where you have shareholder capitalism or capitalism in general, firms are being created, firms are being destroyed. There's gains and there's losses. So it's not just like anyone who's a shareholder automatically kind of gets rich and is made better off. They have to compete with each other, and they're competing to please stakeholders. So it's in the end, it's the stakeholders that get to choose, not the shareholders.
Yeah, that's
Yeah,
yeah. I mean, right. So in capitalism, right. So failure it's a feature, not a bug. And you've
yeah.
laid out perfectly good reasons why that's the case and why we progress from there. There's a question in the chat about some of the other criticisms of shareholder capitalism. You've already answered the one related to the fact that does one of the fallacies is that shareholder capitalism does not take into account stakeholders, and you walk through all that. There's some other ones that I'd like you to respond to. Right. So one is opponents claim, well, shareholder capitalism, particularly for publicly traded companies that have to do quarterly earnings reports, quarterly filings, it leads to this concept short-termism.
Mhm.
What is short-termism and how do you respond to this claim?
Yeah, so the idea of short-termism is that for some reason shareholders prefer higher near-term profits. They prefer dividends. And even if a firm has a good investment opportunity, they would rather the firm skip the investment opportunity to have higher kind of current profits and higher dividends at a high level like that. That's I think one way to think about it. And so, okay, so the problem, I mean, there's many kind of problems with that. So the first thing is like, what is shareholder value? So in shareholder capitalism, what's the thing we're trying to maximize? And I think some of the confusion over it is people think, oh, you care about profits, so you're trying to maximize the short-term profits, and that's just not true. So shareholder value is the value of the business minus any debt. And so shareholder value, if we were to get a little technical, it's you basically forecast all the firm's future free cash flow, which are driven by its future profits, and then you do something called discounting, and you come up with a number. That's the value of the company divided by shares outstanding, and that's an estimate of stock price. Anyone who's valued a business before will tell you the value of a business has almost nothing to do with its current earnings. It has everything to do with how fast you think those earnings will grow into the future and at what rate you think they're going to grow at and for how long. So if you just take like a publicly traded company, like I was looking at Microsoft over this weekend. So I think their market cap is something like 2.7 trillion, but they only have 88 billion, only 88 billion in earnings. So their earnings are 3% of their market cap. So why would people pay 2.7 trillion for something that's today only earning 88 billion? And the answer is because that's just not how you value a business. You value a business by projecting all its future cash flows, not its current one. And so if you're trying to maximize shareholder value, you're not trying to maximize your current earnings. You're trying to maximize the value of the business. What depends largely on how fast the earnings are going to grow kind of over time. And so you take, and same with like Pfizer. Pfizer's earnings are something like 6% of its market cap. If you look at IPO firms, there's many IPO firms that are losing money, but they're worth hundreds of millions or billions of dollars. So first of all, just mechanically, what shareholder value is, it's inherently a long-term concept. It's not a short-term concept. So then we might also ask, like operationally, how does a manager maximize shareholder value? And again, we teach this in our intro finance classes. We even have a word for it called positive net present value investing. And so basically the rule of thumb is that anytime you can make an investment that makes your where the future benefits outweigh the cost, you should do that, and you'll increase your shareholder value. And so like Microsoft, Pfizer, other companies, they spend billions of dollars in R&D. If they didn't spend those billions of dollars, their earnings would be higher, their profits would be higher. They could pay more dividends or do share repurchases, but I would argue that it would probably be worth less because investors recognize that those investments are being put into things that will generate future profits that outweigh the investment. So shareholder capitalism, it's a very long-term kind of view, not a short-term view. And I understand markets can sometimes react very strongly to earnings and things like that, but there's really nothing in shareholder capitalism that says you should try to manipulate your stock price by playing games with earnings. Even if corporate managers sometimes do that, maybe because they're compensated based on that. But if you're trying to maximize shareholder value, the rule of thumb is anytime you have an investment where you think the future benefits outweigh the current cost, you should make that investment. And that's taught, in every university teaches that in every finance class. So no, it is not a short-term thing. Shareholder value is a long-term thing.
Yeah, you must
Yeah.
have one eye on the chat because we just had this is the
Okay.
second time we've had a question come in right while you were
I
answering it.
can't see
It
it
was
actually, but okay.
particularly
Yeah.
on the short-termism, and it was about R&D spending towards innovation because there's uncertain payoffs and it's a very long
Yeah.
time in the future. But we just answered that, so
Yep.
that's great. Keep for folks out there watching this live, keep the questions coming. You guys are hitting exactly on the right topics that David wants to talk about. So. Let's turn to broader societal stakeholders, right? So you kind of you got the customers, the suppliers, employees, that sort of stuff. Broader societal stuff. In the past few years, the concept of environmental, social, and governance issues, or so-called ESG
Hmm.
issues, um, have been, in the forefront. And people say, well, stakeholder capitalism is a much better model to take into account the broader society. And you talked about this a little bit, but I mean, do we even want businesses to pursue good societal causes? And what's sort of the limiting factor here?
Yeah. So first of all, I would say there's problems in the language of that. So when people say, I want a firm to pursue a good societal cause, what they mean I think, a cause that's consistent with their political ideology, their ideological beliefs. So first of all, a for-profit business does pursue a good social cause. It benefits all its other stakeholders. It creates wealth for the shareholders by engaging in mutually beneficial trading with all the stakeholders. All those people are members of society. So it is creating something good for society. Economic growth is important for society. If you go back to like 1970, um, the world had about less than half the population today, like 3.8 billion people in it, and about 40% of the world lived in poverty, according to the World Bank. So today we have twice as many people. We have about 8 billion, and only 8% live in poverty. And I would, and that's largely, I would argue, because the fall of communism, greater capitalism, business market reforms in China. So absolutely, business and capitalism create good things for society. What ESG and other things try to do is basically, people who promote those things, I would argue, what they want to do. And so here you have this corporation, and it has its assets, and it belongs to the shareholders, and it's engaging in mutually beneficial trading. And what you want to do is you want to take some of those assets and you want to use them to promote ideological causes that you favor, that maybe, we can argue if those are good or bad causes. And rather than just kind of call it for what it is, we say, oh, it's being socially responsible. Oh, this is stakeholder capitalism. This is ESG or something else. But really what it's doing is it's just kind of expropriating the assets of the corporation that rightfully belong to the shareholders, and using it to promote ideological causes or things that would typically be done by governments or nonprofit institutions. That's the best way to kind of define it. Because I think it's really important to just keep in mind the word socially responsible is a totally it's not objective. That's totally subjective, right? People can have very different opinions on what constitutes a socially responsible action. That's why we have elections, very contested elections. We don't agree on that. People can have very different opinions on what constitutes good environmental and social policy. And so the problem I have with these kind of labels and ratings is they come across as if they're doing something objective. Like, of course the firm should do something that's socially responsible. Of course the firm should do things that are good for the environment. But what it really means is that's just someone's opinion of what's socially responsible and what's good for the environment. And many people have a very different opinion. I think in practice, what those labels usually confer to is kind of the political beliefs of like social democrats in Europe or very liberal Democrats here in the US. That's usually what those things push assets towards. I'm not saying those are good or bad causes or beliefs. I'm just saying those are kind of like political ideological causes. And so what you're doing is, I would argue, you take a firm and it is doing things that are good for society, and you're trying to take its resources and divert them towards things that maybe some people in society favor and other people don't. And the label is very misleading, because the labeler says, well, I'm speaking for what's good for society, but no, really you're just speaking for yourself. And many people in society probably don't agree with you. So yeah, that's at a high level my problem with some of that stuff.
Yeah, I
It's a bit
mean,
misleading. Yeah.
yeah, no, I mean, I'm smiling as you say this. So, as David Vanderveer mentioned, I was at the Securities and Exchange Commission. One of the things that, if you're a publicly traded company, the SEC requires is public disclosures of material information for shareholders so they can make informed decisions. And when I was there, we would have, a group that would come in on a Monday, and say, hey, we think that these ESG factors, particularly it was like the E part, the energy part, these climate
Yeah,
related things. And we think here's a list of 47 things we would like you to mandate for companies, right? And I would
yeah,
say, well, is this material information? Like, no, we know it's important. And then literally the next day on a Tuesday, another group would come in with a different acronym, still well intended,
yeah,
wanting to accomplish the same thing. And, here's our list of 53 things, and they wouldn't be the same thing, right? To your point, it's somebody's, opinion on this. Now,
yeah.
folks have coalesced over time, and there's material information, that we want to get on particular things. But I thought I'd just mention that as
Yeah.
one,
And
right?
just to your point, there's actually academic studies showing ESG ratings don't even agree with each other. Like
Yeah,
you have six major rating firms and they're hardly even correlated. So it's hard to put in practice. And we should also say we know where ESG came from. ESG it's a United Nations project. The idea of the project was to try to get financial firms to kind of be enforcers of the United Nations sustainability ideology, which I would argue is kind of like a left-leaning political ideology. That's where ESG came from. That was a general idea of it. So it wasn't just some organic thing that popped up. The UN in a concerted effort kind of got together with some financial institutions and said, let's see if we can use banks and asset managers to kind of force firms to pursue things that confer with our kind of political leanings. So it didn't just innocently pop up like that. It was a concerted effort. But then, like you said, when it goes into practice, people can't really agree over how to do it. Um, but yeah,
Yeah. On let's use environment as an example,
yeah,
right? You also bring up the concept of externalities, which is a very
yeah.
important economic concept. What are externalities? And give us some examples. Then I want to have a follow-up question related to shareholder capitalism.
Okay, yeah. So an externality would be so two parties trade, and a third somehow their trading creates some type of side effect that harms a third party that didn't benefit from the trade. So pollution is the classic example of an externality. So a factory pollutes the local area, and people living in the local area who don't really benefit by having the factory there have to suffer from the pollution.
Yep.
Yeah.
All right. So does shareholder capitalism ignore that problem?
Yeah. I would say no. So under shareholder capitalism, you're supposed to follow all the rules and regulations set by the government. And so right now the federal code, I mean, we're having some issues with this now, like with DOJ looking into this, but the federal code of regulation is so long nobody could read it. George Mason University has an AI that they had read the federal code to figure out kind of what's in it. According to them, there's over 1 million regulatory restrictions. That's over 1 million things you're not allowed to do. The most prolific regulator is the EPA. They came into existence under the Nixon administration in the 70s. Every year, the EPA has been adding 3,000 new restrictions, 3,000 new things that a firm isn't allowed to do. States have their own restrictions. So California has 400,000 regulatory restrictions. The New York Times, in a 2017 article, used this George Mason tool to figure out how many just federal regulations would an apple orchard have to deal with. So you're an apple orchard. What does the federal code say you're allowed and not allowed to do? And so the machine went through it and found there's 5,000 restrictions directed at apple orchards, and then another 7,000 restrictions that aren't really written for apple orchards, but apple orchards would probably have to adhere to. So 12,000 total. So it's not as again some of this stuff with ESG. It's pitched like, oh, corporate managers just kind of ignore the environment and all these other things. And in reality, if you can be a corporate manager who doesn't care about the environment at all, but we have governments and rules and regulations, and those are going to make sure that you do. So you can't just ignore that. So shareholder capitalism just says, I think it says regulation should be done by government. It shouldn't be done by firms. And
Yeah.
so yeah, I guess
So
basically, and you shouldn't break them. You should obey them. You shouldn't just ignore regulation. Um,
Yeah. So,
Yeah,
all right, great question just came through in the chat
yeah,
where it says the question here is, isn't stakeholder capitalism and ESG just a reaction in part to government regulations that are maybe controlled, they're either, right, captured by large corporations, some of the bigger ones, those sorts of things. And so,
yeah.
so shouldn't we just use ESG as a substitute for regulatory failures?
Yeah. Well, so like that idea, like regulatory failure is it's an interesting term. So I would say like what's a regulatory failure? So at a high level, a regulatory failure is supposed to be something should be regulated, like the because regulations have cost and benefits. Regulations add cost to benefits. So something should be regulated, but for some reason it isn't. Like the regulation would be beneficial, not that high a cost, but for some reason it's not being done. Maybe businesses are preventing it from being done. And I would argue, what people often call a regulatory failure is just other people don't agree with you that this should be a regulation. So maybe you or I think something should be regulated and it isn't. That doesn't mean there's a regulatory failure. It just means most people don't think the way that we do. And so I think the problem, what I would describe ESG and these other things are that, okay, you want a set of regulations and you can't get it democratically because most people don't agree with you. So you try this other ESG angle. And I would argue a lot of the things around global warming are a great example of this. So like Gallup polls right before the election, when people kind of rank things, like what's important to you, global war, like, climate change and global warming, I think they had 21 different things. It was like 20th, whereas the economy was first. And then other surveys would ask people like, hey, would you pay an extra $10 a month in your electricity bill to fight global warming? And 70% say no. Would you pay an extra 25 cents a gallon in your gas to fight global warming? And the majority of people say no. And so I think what happens is that people like in DC and in academia would want one set of regulation. The general public doesn't want it. And so then the people, who want the there's a regulatory failure. There's some type of corrupt thing going on. And as far as being captured goes, I'll just say this. An oil company has a lot more stakeholders than say like the Sierra Club. So an oil company like ExxonMobil has millions of customers. It has thousands of employees. It makes, when oil prices go up, both political parties do everything they do to get them to go down when gas prices go up. So the idea that there's something corrupt going on that politicians care about, like what affects the price of oil, I don't think that's corrupt at all. I think it's like democracy in action. I would argue like the Sierra Club having a lot of influence. Well, I mean that they represent just, probably just a small group of people, kind of rich people on the coast, people in academia. But when the Sierra Club has influence, we say, oh, isn't that great? This is like good for society. It's good for humanity. And then when the oil company has influence, we say, oh, that's kind of bad and corrupt. But I think in reality, the oil company, represents what a lot more people care about than the Sierra Club and the environmental groups. So I think it's just as legitimate for them to talk to Congress as it is for the environmental groups. And I say that as someone like I who like cares about the environment, but I'm just talking about I don't think we shouldn't have an EPA, but I'm just saying all regulation, especially environmental regulation, has cost and benefits, and people can have different opinions over what the cost and benefits are. And just because, so yeah, I would say ESG and stakeholder capitalism, what it really was is you couldn't get what you wanted democratically, so you tried to do it this way. Rather than correcting a regulatory failure. I don't think there was any failure. I mean, not that those can't happen, but I don't think that's what this is.
Yeah, no, I mean, you mentioned sort of the costs and benefits. My ears perked up on that. Having been a
Yeah.
former regulator, a financial regulator, all regulatory agencies put out for public comment proposed new rules, and they have to take into account costs and benefits, and they have to disclose to the public, this is how we consider the costs and benefits. And the public has the opportunity to weigh in and say, no, you got that wrong. Here's what you forgot.
Yeah.
You're overweighting the benefits or underweighting the costs, all those sorts of things. And that has to be taken into the regulators at the cost of at the risk of actually being the courts, people suing in court and saying you haven't adequately followed the rules on those sorts of things. Let me turn to a couple final questions here in the remaining few minutes. So, you know, corporations, if they're successful, make profits, right? And then they can choose what to do with them, right? So many times they will reinvest them into the corporation. In some cases, they may use put it in cash for now and think about a future acquisition. They may reinvest them into R&D. You talked about the fact that that shareholder capitalism is not short term, the long terms and that sort of stuff. But they can actually pay out some of those profits or earnings to shareholders, particularly a public company, as cash dividends, right? And there's actually been some bills in Congress that have been introduced to put some limits, in some case prohibition, on companies actually giving the cash back to shareholders rather than reinvesting in the corporation. Is it right to assume that reinvestment is always good and payouts are always bad, or is that a fallacious argument?
Yeah. So I think investment. So again, in shareholder capitalism, we want investment, but we just want investment if the value of what you create is greater than the resources that you used. So if I can invest $1 million and create something that's worth $2 million, that's great. But if I invest $2 million and create something that's only worth $1 million, that's not great. So what we want firms to do, if you're trying to maximize shareholder value, we want firms to invest when what they invest in creates value. And some firms, if you don't have that anymore, like you're mature and things like that, then you shouldn't invest that. You should return that money to shareholders. So again, like the basic economic problem, society has scarce resources that have alternative uses at any point in time. How should we use our scarce resources? Well, we need to invest in things that create value, and if firms use resources to invest in things that don't create value, society gets poor. It's literally like negative economic growth. So like imagine that. Imagine we have a rule that says, okay, we want firms to invest in things. So your new investment rule is you can only invest if what you create is less worth than the resources that you used. So here's a $2 million investment and you make something that's only worth $1 million. So if all firms did that at scale, you'd have negative economic growth and we'd all go back to living in poverty. So we don't want any firm to do that, right? So again, we want firms to invest, but we only want them to invest when they create things of greater value. And if they don't have things to invest in, they need to return money to shareholders. And the idea, if firms never return the money to shareholders, then like let's say you passed a law that said you could never return money to shareholders, I don't think the shares have any value. I don't see why anyone would want to be a shareholder. So when we value a business and we discount its free cash flow, we're assuming that those free cash flows actually belong to the shareholders. They can be used to invest in things that create greater value, but when we don't have those investments, we want them. It needs to be returned to shareholders. If you don't do that, they have no value. Just think of a private company. Imagine like you start a small business, and the government says, okay, you can start your business, but when the business makes money, it goes in the business bank account, and you're never allowed to take money out of the bank account. You can reinvest in the business, but you can never use it for yourself. Like, why would anyone want to own a business like that? It doesn't make any sense. And so it's the same thing with a publicly traded corporation. It's just a bigger, more complicated, organization with lots of different shareholders. But if they never get to keep any of the profits, then why would you want to be a shareholder in that business? And interestingly, some of the people that promote that are lawyers. Law firms are organized as partnerships, and lawyers don't seem to have any problem understanding who the profits of a law firm belong to, right? I mean, I think lawyers all understand that when a law firm makes a profit, that belongs to the partners, to the lawyers. It's not some philosophical question over what happens to the profits there. And so I would say a corporation is the same thing. It's just a different legal structure, but it's still a business with owners. And if the owners don't get to keep the profits, then what's the point? Why would anyone want to do that? Become an owner?
So we're almost out of time here. Let's end the final question about the future of shareholder capitalism.
Yeah.
I found it interesting in your book, the conclusion of your book begins with a pessimistic quote by Joseph Schumpeter, who we talked about, where he says, quote, "Can capitalism survive? No, I don't think it can," unquote. Now, he wrote this in 1942.
Yep.
And you point out when he wrote this, intellectuals had been attacking capitalism for 60 some years. And you talked about that earlier.
Yeah.
Since then, the intellectual attacks on capitalism have not abated. In many cases, have gotten worse. They kind of ebb and flow and stuff. So, how do you envision the future of shareholder capitalism in light of this stuff? Are you more optimistic than Schumpeter?
I guess so. So I think if we look at the history of the attacks a little bit, we can maybe think about what happens going forward. So I would say the first major attack was communism, right? Communism is based on the idea that capitalism itself is unsustainable. can't keep going on. So that was the first major attack. And then communism failed because communist countries weren't successful and capitalist countries were, and so on. And then in the 50s and 60s and 70s, they developed a new communist-like ideology, and I refer to it as the first version of the sustainability ideology. And that was based on the idea that economic growth was unsustainable. We were using up all the planet's resources. The planet was overpopulated. And so what we needed was governments to come in, and we should really strive for zero economic growth and zero population growth. And this idea was heavily promoted like by the UN, by the World Bank, by USAID, led to China's one child policy, led to forced sterilizations. Like India had a two year ordeal where they sterilized 11 million people with help from UN and USAID and things like that. So this was a big, and you would have UN conferences just like today you have them on global warming, you would have them on overpopulation. And so now that ideology was in its heyday, like 70s, 80s. But what happened is that the world's population kept growing and poverty rates kept falling. So it looked like what the people were saying was wrong. And by the way, it was all scientists and things promoting this. These are like professors at the head of this out of places like Stanford, MIT, Berkeley. Um, and so then I would say, and probably in the 90s, the sustainability ideology switched and it became more about global warming. Today when people talk about sustainability, especially in the context of business, it can have to do with global warming or DEI or just kind of like a checklist of things that kind of maybe progressives would favor. Um, and so where I think that is going, so I think this wave will probably last for a while. I think there's been some pushback against it, but I think this type of thing keeps happening. I think intellectuals, and when we talk about intellectuals, we're talking about people at kind of like places like the UN and academia, various think tanks, maybe government bureaucracies, um, tend to like to find problems with capitalism, with freedom of choice. So capitalism's causing all these problems. It's unsustainable. We have the solution to it. The solution is kind of give us more power and put us in charge and let us kind of control things. Um, and I think, and if you look at like what was ESG about, again, ESG came from the UN, and ESG was about using banks and other financial institutions to get the rest of the society to confer with the sustainability ideology, which today is about global warming. It didn't used to be. That kind of was a switch. And that's not to say that the Earth isn't getting warmer and that humans aren't causing it, but people can maybe disagree over how big an emergency that is and how much of our resources should be kind of used for that. And if you look at the UN today, and I guess maybe why I'm optimistic, they recently had their last kind of global warming meeting, and 50,000 people flew into this meeting on planes. Because that's what you do if you're concerned about global warming. 50,000 people go travel to a conference. So 50,000 people travel to a conference. The conference decided that rich countries need to send poor countries 300 billion a year to fight climate change. That's what people agreed on. The poorer countries, some of their spokespeople said that's an insult. It needs to be a much higher number. The UN says actually to meet their 2030 climate goals, wealthy countries need to send poorer countries 2.5 trillion a year. That excludes China. And so I think people kind of look at this and just say this, it's gotten a little too crazy, and that's kind of enough. I think this last election outcome, I think, was pushing back against some of that. So I'm optimistic, but I think even if the global warming thing dies down, something else pops up. This is just kind of how it works, and we kind of need to be aware of it. But if you want further economic growth, you want to continue getting people out of poverty, you want people living in prosperity. Profit-seeking business is the thing that does that. These other ideologies haven't contributed anything to that. And if anything, like the greatest threat to capitalism is these types of ideologies that keep popping up, and that are I guess right now trying to infect the business world.
That's a great note to end on. So,
Yeah.
Professor McLean, thank you so much for joining us today, talking about your book, Shareholder Capitalism, and how the pursuit of profit benefits all. Again, I encourage all of our listeners to go out and read the book. We only scratch the surface on a number of topics that are in the book. There's much, much more in there. As you can tell, he's, has incredible knowledge on history, economics. As I said, I learned a ton from the book. On that note, for our listeners, if you're in Washington, D.C. on September 25th, please join the Passero Center for our annual Financial Markets Quality Conference. It's the go-to conference for policymakers, regulators, senior executives, and market participants, where they discuss critical financial issues and propose solutions to strengthen the global economy. Professor McLean will be there signing this wonderful book. If this piqued your interest, I encourage you to go to the conference and meet him there and have a great conversation with him like we just did here today. So thank you all for joining us.